Yeah, good afternoon, Adam from MarketChameleon.com. That's Dmitry. How's it going today, man?
Hey guys, how's it going?
Oh, man.
Hey Adam.
It's kind of sad that it's the end of the week, man. It's our last
Yeah,
day doing the afternoon show.
I know it was a fast week.
it
Flew by.
is, right?
Is
It's a
Will
lot of
back?
fun. Yep. So Will should be back. He's back from his Caribbean cruise. I think he gets back tomorrow night, but he should be back on the morning show on Monday. So we should be live
Nice.
Monday morning. But we're definitely going to have Dmitry back. We'll have him back afternoon sessions to do extra work with us and maybe build more models, deeper models, all this sort of stuff that people are asking for. How does that sound,
Awesome.
Dmitry?
Yeah, that sounds great.
Amazing. Why don't you go
Yeah.
ahead and bring your
Aw-
screen up? While you're doing
Okay.
that, I will put up the disclaimer. Everybody remember, option trading is risky. We are here to give you ideas. We are not here to tell you what to buy or sell. That is for you to do your research. Also, remember, if you're on YouTube, click the subscribe button, tick that bell. We're live here Monday through Friday, and you can follow us on YouTube. If you're watching us on MarketChameleon.com, you can follow us on YouTube. So Dimitri's got his screen up. What do you got for us today, man?
Hey Adam. So today we're gonna start building what a market making model would look like. So this is what a professional trader would start taking tools that are available to him and assembling it together to make an edge, right?
Yep.
So to make a profitable model. And I'm doing this as an illustration, so I'm not using real numbers. I'm just doing it so conceptually the viewers could understand the logic and the mindset of a trader or a market maker.
Awesome.
Uh, right. So the things that we're going to talk about today in the market making model is, and we mentioned this before, internalization and payment for order flow.
Mm-hmm.
And I think it's a little bit it's important to understand if you're trading in today's market
Yep.
to kind of know the landscape, what's going on, what are the rules. This is going to help you become a better trader,
Sure.
right? So I wanted to discuss this a little bit, and it'll probably even explain some of the things that people often have questions, like why does my broker have commission-free trading? What are they doing? Right. It, then I wanted to take that and add a few more things in there, like depth of book.
Uh-huh.
How can we use the depth of book to, or as a market maker, what is he doing? How is he using the depth of book to possibly gain an edge, right? And then a little bit of, if we have time, how to apply a little bit of math. And when we talked about trading edge yesterday,
Yep.
I said there's different types of trading edge. So there's an edge. There could be a mathematical edge, right? A statistical edge, but there could be other types of edge, and that's why we're talking about the payment for order for internalization, where you
Mm-hmm.
could use either, and this is what would be a privilege, right? This would be considered a privilege because it's available through the SEC. The SEC creates the market structure, they change it around, and through the SEC, they make things available to, or privileges
Now, when you
for
say the SEC, you mean the
securities and
no, no. I was gonna take. No, dude, you cut off my Elon
oh,
Musk joke, dude.
sorry.
The short sellers enhancement club, or whatever he called it.
So yeah, and so we'll go over these three today,
Sounds great.
and how to put them together, right? How to create an edge, and you have to work within the legal framework because there's some misconceptions that people have about how things, because you cannot front run orders, you cannot
Right.
manipulate markets, you cannot flicker. So within the legal framework, you have to actually create a working model, right?
Yep.
A working profitable model.
Yep.
And yesterday we talked about how the casino makes edge.
Right.
So the casino on this side, they have a statistical edge, right? They have a statistical edge
Mm-hmm.
because whoever bets on red, black, then you have these two greens that gives the casino a 5% edge.
Right. So
Right.
still have risk, but they have an edge.
Exactly.
Yep.
So they still have risk, but they do have an edge. And then you have the players over here, and we're gonna create an analogy today. That's why I'm coming back to it.
Mm-hmm.
Then you have on this side, you have the players, right? They're the people who are trying to predict the next outcome
Right.
the spin, and they don't have an edge, right? They have a negative edge. They might think they have an edge because they
Because
think,
they're
well,
delusional.
yeah, and some right. They think they have an edge, and part of it is also it's psychological, right?
Sure, absolutely, man.
If you have all these people, right? When you go into a casino, you have all these people all trying to.
Yep.
You, so it's so if everybody else is doing it, you're going to do it,
Exactly.
and
Yep.
right. And maybe they don't think that there's an edge. They just want to play the game. It's just exciting for them. So it doesn't really matter to the casino
Right.
why they
Yeah,
do it.
that's true. I mean, I know people who go to the casino and they know they literally walk in and like, I have $500 to lose,
Yeah.
and they'll
Yeah.
basically sit there till they lose the $500. It's just
Exactly.
entertainment. That's what that is, right?
Yeah.
But
Yeah.
that
And
you don't want to do that with your 401k, man.
no, you don't want to do it with your 401k. And for whatever reason these people are playing, this person, this to them, it's a business, right?
Yeah.
So to them, they have to treat it as a business. Um, and the similarities right now, we're going to talk about internalization. So let me just come back to internalization and payment for order flow.
Mm-hmm.
It's kind of the same. It's the same thing. Internalization is when a broker has he has your order, right? So you send an order through your broker,
Right.
and he has the ability to trade against that order. So
Sure.
this is the SEC, the internalization. When you place an order to buy or sell, your broker has a choice on where to execute your order. Instead of routing your order to a market maker, your broker may fill the order from the firm's own inventory.
Mm-hmm.
They could do that, or they could sell it, payment for order flow, where they, instead of, and this is, from the SEC's website. So some market makers will pay your broker for routing your order to them, and perhaps they may even improve it.
Mm-hmm.
So here's there's a few reasons why you would want to do that and why there's edge in that. And the rules right now are as long as you could trade against that order, but let's just say the market is, the bid on the stock is 23,
Mm-hmm.
the offer is 23.05, right? So if you went to the market, if they executed at the market and you wanted to sell the stock, you could sell it at $23.
Right.
Or the broker can, from his own inventory,
Right.
he could buy it from you for 23.
Yep.
And the other way around, if your broker, he has an order to buy, he could fill it at 23.05 in the market, or he could sell it to you for that same price.
Right.
That's right now, that is the rule. And he can't front run your order, so it's not legal for you to give him an order to buy. He goes, buys in front of you.
Sure.
That's legal. But what I just described, he could do that or sell it to a market maker who can do the same thing.
Yep.
So the reason behind that is why there's edge is if you're on this side, right? If you're on this side, you're the casino. You want to have, and the casino will acquire customers as well. You want to have as many of these players who are not informed, they're just there to play against, the odds that you set.
Sure.
But what you want to avoid is what we call is an informed trader. So the casino does not want somebody who counts cards or
Right.
who could rig the game into their favor.
Right.
Right. They don't want that.
Right.
So they want to avoid what we call.
And they also don't want kind of what we talked, the big one-off player. The casino anyway doesn't want the guy coming in throwing $1 million on black, right?
Yeah, they want it right, and they won't do that. Exactly.
They won't let you do it. Yep.
They won't let you do that. They won't let you do that. But they want as many of these types of players who are just trying to play the game the way it's set,
Mm-hmm.
right? So they still have a statistical edge, and they certainly don't want anybody who can cheat or knows how to
play the game. Yeah.
how to play the game.
Mm-hmm.
So when we talk payment for order flow, this is coming from places where they already know these are uninformed trade. They're not like
Right.
high frequency plugged in traders. These are traders, and they could be right, by chance. They
Sure.
could be right or they could be wrong, but they don't know. They shouldn't. They're not plugged in somewhere where they could just come in there and you know take advantage of.
So they're looking for large volumes of those people to
Yeah,
come
and
through
these are
them.
going through the pipes, right?
Yep.
So that's how payment for order flow or internalization started.
Sure.
And actually, the payment for order flow was started. Do you remember Bernie Madoff?
I
Do you remember
love.
he was
Of
one of the
course.
in 1980? Yeah, he was the one who actually kind of pioneered it, and it's still around.
Oh,
It's
so
still
smart.
around.
God, I wish I was so smart like
Yeah.
that.
That's one of the advantages.
Yep.
You don't risk, you don't put yourself out there to adverse selection. That's what it's
Yep.
called. So you're not at risk to that.
Mm-hmm.
Now another benefit is, and it's not as clear, as the way it's set up, right? And let me just make. Oh, and by the way, what I did forget to mention yesterday before I move on is, you see here the casino, they obviously they have a risk, right? So they could lose if a lot of people bet on red one
Sure.
time on red, they could lose. So they do have a risk, but what they depend upon over many spins is
Yeah,
a
of course.
statistical edge, right?
Yep.
They need many spins. What this is, and some people get confused when they hear high frequency trader, right? Because you're going to hear, oh, high frequency traders, they're very fast, right?
Right.
That's what the assumption is, they're very fast. So look up the definition frequency. That it doesn't mean fast, it means you trade a lot.
A
It's
lot.
Laws, laws of large numbers. If you
Yep.
have a statistical edge, just like a casino,
Right.
it's laws of large numbers. They could lose 5, 10 times in a row.
Sure.
Right. But it's laws of, and that's why they don't like just one big bet,
Yeah.
1 billion, because they're still at risk.
Absolutely.
They're still at risk.
Yep.
When we talk about, and there is a strategy for being very fast, and that's
Sure.
called low latency, right? That's actually called low latency strategy. And that's if,
Yep.
for example, you have really fast computers that could, the Fed made an announcement, you could analyze it, and then you could just trade off it.
Sure.
It's faster than anybody. So that's low latency. And they could be conflated or they're separate, but high frequency doesn't necessarily mean you have to be fast. You could
Right.
trade once a day, but if you're trading every day, that could be considered already a high frequency because you're playing a statistical game, laws of large numbers, right?
Right.
So you shouldn't expect to just make one trade and that's it, or two or three or four. It's laws of larger numbers.
Yep.
That's what that
I mean,
is.
Will touches on this literally every single day when he starts talking about, option trading and trading very, very small and many times, right? That's what he talks about all the time. So, yeah.
Right. Exactly. Exactly. And that's what you want to do is trade many times, small with a statistical edge.
Exactly.
Just like we would do over here.
Yep.
So let's just.
And by the way, this is completely against the way most people trade, at least when you start and you do stupid stuff like Will and I did when we were living in Chicago, thinking you have some information and boy, I'm just going to make big stock picks and thinking you have great information or whatever. And you get ruined.
You let it.
This is the exact opposite of that.
It's the exact opposite, and that's the difference between you're either a trader or an investor. If you just want to make one trade, if you just want to make one trade or two trades, or you're an investor, you're holding a portfolio, right? If that's your goal, which is fine, that's perfectly fine. You could just, but if you're a trader, if you're in the business of buying and selling risk, you almost have to be a high frequency trader, right?
Sure.
Because if you do it 2 or 3 times, that's not a trader. That's an investor, right?
Yep.
You could just pick a stock hold
or a gambler, whatever you want to call it.
Yeah, or a gambler, but yeah. And in 10 years you'll see, or 5 years you'll see what happens.
Sure.
Right? Hopefully it goes up,
Yep.
And you pick the right stock.
Yeah.
But that's not a trader. That's an investor. But today we're talking about trading, especially if you're trading options. You're kind of forced to be a trader because the nature of options, they expire, right? They're
Sure.
going to expire. You can't unless
You
maybe you
can't sit
buy a
on something
lead.
for 20 years. Yep.
No, you can't do it.
Yep.
Um, so let's start building a market making model. First, we're going to talk about, and we're going to use these tools. We're going to talk about internalization, right? Internalization, and let's do first, and then depth order book. Order book depth. Now I wrote out this whole mathematical, and I'm going to try to simplify it, okay, just to show the concept of what's happening. So the order depth books looks something like this. You have in the beginning, when you're looking at a stock, right? You're looking at a stock and we'll do it again, 23 bid, 2305. This is what's called the NBBO, National Best Bidder Offer. This is what you're pretty much looking at, and then you might have something like 1,000 shares bid for, and then let's say 2,000 shares offered. Mostly that's what people are looking at when you're doing trading. And the depth of book goes beyond that. So there's a cluster, there's a cluster of bids, right? Cluster of bids below this, and a cluster of asks above it. This is what you would start looking at, not just the NBBO, but what is the true bid size and true ask size? Not just the lit, but what is it? Because remember, the stocks are moving around. They have a volatility minute to minute. So they don't just bounce around these two numbers.
Sure.
So you need to know what's clustering below that and above that. And that's how you're going to, as a market maker or as a professional trader, you're going to start looking at that.
Okay.
Because if there's a big pocket, right? If there's a big clustering of bids below and you have this big pocket between 2305 and the next price is like 24, you're in trouble, right? So because that disappears and boom. So that's the order books. And let's just take a look what it would look like. I like to doodle people, right? So let's just gonna do
Wait,
this.
are you gonna draw guys on the trading floor?
Yeah.
Buy. Sell.
So these are the people who want to buy, right?
Sure.
And let's just bear with me, and I'm going to put them next to it. So there's like a bunch of these people, right, lined up.
Okay.
Okay. This is our depth of book, right? This is our depth of book. They're lined up. They want to buy this. We're going to call it bread.
Okay.
Okay. Then on this side, we have a bunch of people, and they're sellers. They have the bread, right? Kind of like these people want to buy the stock. These people want to sell it. These people want to buy the bread. These people want to sell it.
Yep.
And this is how it's going to look to you. And you're the market maker right here, right? And you're looking at both of these. This is your view, right? So you're like, whoa, there's a bunch of
a lot
people,
more buyers than sellers.
A lot more buyers than sellers.
Right.
They're all clustering together, and some of them, you have like a bunch of them here. They want to buy the bread for like $4 or
okay.
Then you got a bunch of them here. They're telling you, right? Because when they're bidding for stock, they're telling you what they want to do. They're giving you that information. So you have this information, and then you have, these guys who are trying to sell it. They're So if these guys are trying to buy it for 4, these guys are trying to sell it for 5, until something trades. The fair value, what we call the fair value, is somewhere in the middle. So we don't know, right? Either they're going to meet in the middle, or somebody's going to sell it for 4. So the fair value is somewhere in the middle. And now you're the market maker. You're making markets, and you have payment for order flow. So somebody comes into you, right? Now, so look at the advantage here. Right now, you're not standing in line, right?
Sure,
you're
out
standing,
of
you're not even standing anywhere in this line.
Right.
But because of internalization, you can jump in front of either this guy or this guy.
Gotcha. Yep.
Okay. So as soon as you see an order, you can opt in and say, I want to buy this bread.
Right.
Or you could pass, right? That's the rule.
Right.
You can't front run it, you can't manipulate it, but you can jump in front.
Gotcha.
Okay. So this is how it would happen. You have a customer come in, right, and say, oh, I need to sell my bread for $4. Sell it for me. And you're like, well, look at all these people's, you know what? I'm going to buy it, right?
Yep.
So I buy this bread from you and I put it in my inventory. So now I have this piece of bread.
Here, move the bread up a little because you're below the margin. I can't see. I only see the top of the
Okay. Yeah. So I bought this bread. Then you have another guy come in and say, oh, I have to sell this bread for $4.
Right.
Like, oh, you know what? This line is still kind of big. I'm going to buy it too. So now you bought this for $4.
You bought it. Yeah, exactly.
Yeah, you bought it.
You bought it. That's right.
Right. You bought it because you think the fair value is somewhere like at what you're seeing, right, is like somewhere like 450.
Exactly.
Right? Because it's going to be somewhere in the middle here, 450.
Yep.
And now,
can you imagine this used to be done in people's heads?
This used to be done in people's heads.
I mean, it's incredible. Like when I worked in Chicago, literally nobody had a computer on the floor. I mean, it was literally done on pieces of paper. It's incredible how this has moved. Yeah.
Right. It's progressed.
Yeah.
Now it's, and look what's happening right now psychologically. The buyers, right, are starting to get frustrated because they can't buy their bread. Right? They're waiting in line and they see it at $4. Right? Oh my God, somebody bought another piece of bread for $4, but I'm not getting it. Somebody bought another. Right? They're probably seeing it, but it's not moving.
Yep.
Now here's what else could happen. Now you see here, there's another two people, let's say, but they're way away. Like they want to. Let me just make a copy. Now look, I'm just giving you an extreme example just to show you how it might work, right?
Yep.
I'm not saying this is exactly how it works. I'm just showing you for conceptual reasons. Now it's like $7. And you're, okay, I have a person now coming to me, so I control the order flow. Somebody's coming into me and says, I need to buy the bread.
Right.
Right? I need to buy the bread for $5. Now you have a choice. You could say, okay, I could sell it to him out of my inventory, but you know what? I'm going to pass. I'm going to pass because I think it's worth more. So look what happens. You pass. Boom.
Yep.
Right? The book's starting to walk up.
Mm-hmm.
Right? Then you get another guy. I have to buy bread. You pass.
Right. Right. And then the bread you got, ooh, baby.
Right. You see, because now what you do is you have a clear view.
Yep.
Right.
And you can sell that bread that you bought earlier. Yep.
Yep.
To the guy for
now,
$7. Yeah.
Yeah. Now let's say at $7, whoa, these people are like really lining up. Right. Yep. Now, like, let's just say at $7, we look, well, there was like a bunch more. Let's just say there was a bunch more.
Yep.
Over here, you're like, oh, okay, now I'm going to start unloading it,
Absolutely.
And you get a buyer, huh?
Yeah, absolutely. Yep.
And that's how
market makers make money.
Right. So you see, because it's not necessarily they're, people are like, oh, they're flipping pennies. They're just using the information and the tools that are available to them.
Yep.
Right. To make a model that works.
Absolutely.
Of course, I just simplified this and made it so you could visually and conceptually see it, because with the numbers, it's much harder. And believe me, I wrote out these numbers.
Wait, you think this is hard, Dmitry? This is easy stuff, man. This is easy, man. I used to do this with a notepad and a sharp pencil. That was me, man.
Right. And sometimes this, remember, like, he's got inventory. He still has risk, right? He does have inventory, and somebody comes in with a lot of bread. Sure. And he's like, I'm going to just sell all of this. So what happens? Just like the casino,
Yep.
you come back here and you got to start all over. You reset, right?
Absolutely.
What
Yep.
is the new fair value? So you have that edge, just like the casino. You have an edge. It doesn't mean you're going to win on every spin. You're going to be paying out, right? Sometimes the casino pays out, but it's the laws of large numbers. Because you have that edge, um, that's that's what gives you over time. It adds up. And this is, I didn't even show mathematical edge. This is more of a conceptual edge. How you could use tools to, right, to get an advantage.
Yep.
Does that make sense?
Absolutely, dude.
Okay. The other thing is, look, there's no perfect model, right? So there's no one model. This is just a an illustration, right? There are many different models that are getting tweaked, and they evolve, especially with market structure. So the market structure, the SEC comes out with a rule, maybe things will change. As you can see, this has been around since 1980, but things may change, and it's important. Now, you don't necessarily get hurt by it as a retail investor. It's just important to know the mindset, how people work, and what's going on, right?
Yep.
So you could start kind of thinking differently. So you could kind of start thinking along the lines of how do I model things? How do I think about things? How do I find an edge, right? And that's why I wanted to kind of just give an illustration of one possible model.
Man.
So I think
that seems pretty complex. That seems like that might take a little while to build.
Right.
Dude, I recommend, look, man, this is what I recommend. We just do this show like once or twice a week, and we build out the sickest model, man, ever. And you and I just retire on the beach somewhere, living the dream. How's that sound, man?
That sounds great.
No, people, I mean, I've talked to people
the dream,
they don't realize that the whole Chameleon is kind of an outcropping of basically you and Will building these models for years and years and years. And this is like like a life work, right?
Yeah, right. And before you build any models, like, you have to have the mindset, and it's very hard unless you have this mindset, because mostly it'll be somewhere around here.
Yeah.
In the beginning, it'll be, because you don't have 10,000 people walking into a casino, right?
Yep.
Like, these players who are already walking into a casino, how many of those say, how do I become this guy?
Yep.
None. Doesn't happen.
Almost none.
Right? It's very hard. Almost none. Right? They'll just come back and for whatever reason, they might just have fun. That's fine.
Sure.
But not that many people will start thinking, and some might walk away and say, you know what? This is the guy who's on to something.
Mm-hmm.
Right?
Oh, man. I tell you what, once you make that switch in mindset, it's totally different ballgame. Completely different.
It's a different ballgame. Yeah, your mind, your process, the way you process things is going to be much different.
Totally different. I mean, I work with a guy who started out as the uninformed trader, right? And got into, his dad got him into option trading slowly over the last 3 years, built his own models and do all this sort of stuff. It's a completely different ballgame. Completely different. Yeah. And different person.
Right.
Looking at trading differently. There's no swinging for the fences. There's no trying to hit the magic home run pick. No, it's consistent, small trading, small portions of portfolio, and understanding it's a long game. How can he get edge wherever he can get it, and just trading that edge all day long.
Right.
Yep.
Right. Exactly. And that's kind of like where we're starting to slowly move.
All right.
By showing examples. I think by showing examples is the best, or illustrations.
Absolutely, man. I think people got a lot of value out of that today. Remember, everybody, you got to click below. Click the subscribe button if you're on YouTube. Tick that bell so when we're live, you can join Dmitry and I. Will starting next week, but we're definitely 1,000% going to have Dmitry back on for some afternoon shows where we're going to build out this model more and go more in depth numbers-wise as to how you guys can start doing this on your own. and start creating for yourself these sort of models and get thinking like a casino rather than a gambler. How's that sound, dude?
That sounds great. And guys, thanks a lot. It was a great week. We got like a lot of like, awesome emails and it's
Absolutely.
very helpful hearing from people. So, and if anybody has a request, just email it. We're going to try to work that into the videos.
Absolutely. All right, Dmitry, have a great weekend. Thanks everybody for joining us, and we'll see you back here Monday morning.
Thanks everybody.